Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Happy holidays. Well, we're not there quite yet, releasing this a little bit ahead of Thanksgiving, but this will be the last pod of the year, as we'll be taking off Thanksgiving through New Year's Eve, as we've done in years prior. So the greeting makes sense, at least to me. So I want to send you off in style. We got two of my favorite guests to come on and talk through the election and what it might mean for markets, what caught their eye in 24, what 25 might look like. We're talking with none other than Jason Buck of Mutiny Funds and Zed Francis of Convexitas, both of whom are no strangers to the pod. They get into all the nitty-gritty on trend, vol, rates, and more before we take a little detour at the end and discuss who is on each person's Mount Rushmore for best burgers, dive bars, and fine dining. Send it. This episode's brought to you by RCM, from clearing to execution, portfolio construction to outsourced fund ops. China to Nebraska, RCM has you covered for all things futures and derivatives. Learn more at rcmalts.com. And now back to the show. All right, everyone. We're here with two guys I've never met before. Jason Book. How do I spell your last name? How do I pronounce that? Oh, Buck.
Thank you.
And Zed Francis. Welcome, guys.
The I is silent.
Oh, the I is silent. Franks. Zed Franks. So wanted to get my two pals on here. Talk about what's gone on so far this year, maybe what people are sleeping on that should have been a story and wasn't, and even the big stories, what do we make of it, and then what's in store for 25. I'll start with Jason. Like, how you love making predictions and macro calls on based on elections and whatnot. What's your thoughts on 25 real quick, or what's your thoughts on the overall prediction market, I'll say?
I've already been bamboozled. I was told this was going to be a podcast about food and not about global macro predictions. So the only thing I think is interesting is, after the first Trump election, 2017 was like the lowest vol environment ever. We had 15 straight up months for the S&P 500. Now, are you going to bet on that for 2025? I don't know. I think I don't think it's a predictor, but I think it is fascinating that that's what happened. But the reason why, as you alluded to, I hate predictions is actually there's a story from Going Infinite, the book about Sam Bankman-Fried, where he brought up when he was at Jane Street. Apparently, he worked on a project. So I think this comes from SBF, so I'd take it with a grain of salt. But allegedly, he worked on the project at Jane Street for the first Trump election, where they were trying to get election results faster than anybody else, and they had modeled that for months and came up with a system, and they were getting election results faster. But they expected in a Trump win to be bad for the stock market. So they were shorting the S&P 500. And so they originally were up because they were getting the early election results. They were up 300 million on the trade. Well, in the middle of the night, the markets decided it would be good for the economy and went the other way. And it reversed on them. They ended up with a negative $300 million loss. And if true, that's the biggest loss in like Jane Street history. And it's a $600 million swing. So like the other day when I had my in-laws were asking me prior to the election, what are my predictions, what it will do for markets, et cetera. I always, my favorite answer is I don't know, and nor does anybody else.
And said we were on the golf course with a friend who works at Apple or Amazon, I think. Amazon. He's like, "Ooh, hey, two finance guys. What do you guys think is going to happen? What do you think is going to happen in markets with the election?" And you echoed my thoughts. What were they?
I'm pretty sure I've said the same thing every time, but just vol crush, and everybody's going to move on with their lives shortly thereafter.
Yeah, non-event. Right? Both of us kind of said like, non-event. They're both the same in terms of markets, probably.
And I think what's actually interesting is last week S&P option volume was below its yearly weekly average. So you have like the main event and an FOMC meeting, and actual trading activity was a smidgen below the average for the year. So you're like, I think that really shows you that it was all the news was pent up, like what is going to happen. And then whatever was going to happen, almost like no matter which way anything, as long as it ended, we were all going to move on from it.
Zed and I talked about this before. There's a trade where you can trade the IV ramp going into earnings. It's interesting as volatility will tend to pick up going into an earnings announcement. But what's interesting when you do that over multiple quarters and everything, you start to notice this like echo of volatility, where if earnings had a surprise the last quarter, you'll see implied volatility ramp higher going into those earnings. So people are really on recency bias. And I always thought it was interesting in the 2016 original Trump election, it was kind of unprecedented, and so volatility kind of popped during at that election night. And so what was interesting then going into 2020, because of that recency bias from 2016, even though it was 4 years ago, it's just one iteration, they were really pricing in the volatility for the election, and there's a huge kink in the vol surface around the election on November 5th. And so that was interesting that this time it was down a little bit, but it just shows that like even these small iterations over, with 4 years in between, we tend to like kind of price in the recency bias. And then so like Zed was saying, with this one being quiet and popping, it'll be interesting to see if the next one has kind of a low implied volatility going into it. Zed, do you have any thoughts on that? Or
The 28 one you're saying?
yeah.
No, we don't want to talk about it yet, Jason. No, I think it was just too clear. Like vol was too darn high, right? So if you remove last week, the month-ish leading up to the election, realized volatility in the S&P was between 9 and 10, essentially. And intraday, if you just took the high and low of the day, was like a 4. So it was like we weren't moving close to close. We were moving even less once the market was open. So just absolute dead zone. And, finger in the air, you're like, okay, what should implied volatility in the S&P 500 be? You're like, about 15%. What realized is. And then the wings, obviously, that pulls back towards the middle, but like 15%. So you'd be like, okay, the correct no event volatility for the S&P 500 is, I don't know, 11 and a half, 15% higher than 10 would be your finger in the air. Like we went from day before election, implied volatility over the last year being like 93rd percentile, skew was like 98th percentile, meaning puts were expensive relative to calls in terms of steepness. Vol, people buying calls and VIX was like 96th percentile. And then by last Friday, implied volatility was 50th percentile. Skew was like down to like 54th percentile. Vol was 57th percentile. We all went right back to like the middle of the last year. And surprise, 1 month S&P implied volatility was like 11.6. Exactly, 15-ish percent what realized volatility was prior to the week's event. So we just we were way overpriced for a long period of time. Event happens, and then everything went right back to, in theory, where it should have been trading the whole time.
What historically has that happened in all elections, or that you can remember, Zed, or you have data for, or is it because of January 6th last time with Trump, and because there was the specter of maybe the contested, or we don't know who wins for a long time?
The risk being priced into this event was higher relative to how little risk was like actually in the market, right?
Yeah.
So the spread, if you will, from how elevated implied volatilities and how steep skew was relative to the very limited nature of risk that the market had in leading up to the event was very dramatic, like that spread. I mean, if you about 4 years prior, implied volatility was a smidgen higher than what it was coming into this one, but we were also moving like crazy. It was 2020 rather than watching paint dry and having one of the best risk-adjusted returns years that we've seen basically since 1995. So very, very different outcomes. So I think most of the charts will be like just picking a vol number and being like, oh, it was high but not like outsized. But you're like, well, relative to the actual risk in the marketplace, it was pretty darn dramatic how expensive, if you will, volatility was going into the event.
Do you think related to that, like I was thinking, I'm sure you guys heard the same things. Like almost everybody I talked to or everybody I heard talking about it was like, oh, we'll see how long it takes to know the election results, right? Is this going to be contested for weeks or months? And to me, my contrarian nature just want to take the other side of that, right? Because everybody operates off a recency bias, right?
Yeah, no, I think because whatever, every poll was like, oh, he's way up, oh, she's way up, whatever the Iowa one the week before, right? And I think the real answer is we know the data truly is just garbage.
And polls, who
so
answers their phone anymore, right? If there's a number you don't know, are you answering your phone?
And what is it? The fun French guy trade, the thing that he looked at was the ask your neighbor poll,
Yeah.
which, essentially is forget you lie if you talk about yourself,
Yeah.
but you don't lie about your opinion if somebody says, "Oh, what would your neighbor do?" But all this I think is just throwing numbers at the wall, and the answer is the wings were just as likely as nobody knowing and things being close.
I love this concept of recency bias spanning years, and you could
Exactly.
probably argue of like, well, the last World War, blah 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 happened, right? We have recency bias going back 50 years, 100 years.
Well, it's election cycles, right? It's just like our other favorite 4 years of the Olympics, right? But like, yeah, so if you're talking about a few elections, right, you're going to be back several decades. So it is the recency bias of that. And then for 2025, though, what do you think? Like, correct me if I'm wrong. Like, this is the whole thing about markets, right? Why I don't predict is because they can do wonky things or do things that you don't expect. So, I don't believe a politician when they're going to get elected. But with Trump said he's going to apply all these tariffs, right? But then obviously you think about tariffs, you're going to have competing tariffs of everybody retaliating as well. All of that should intentionally, essentially, if you read your, macro textbook, should be inflationary. So is that something like we should be thinking about for the future? But if everybody, the expectation of the inflationary nature of that is like, what I'm saying? Like, once again, back to like
just big game theory.
yeah, it's the Keynesian beauty contest. Like the example of that was like the French, prediction market guy that thought, oh, I'd ask my neighbors of what their neighbors think. It's like, once again, is like, is it kind of priced in or expectations?
So that was by far, in my opinion, the most interesting thing last week was the long end of the Treasury curve, right? So as you're saying, everybody leading up to the election, the known trade was, Kamala wins. That's going to be stagflationary, lots of spending, more regulations, whatever, more of the same, but on that side of the house. Like, oh, Trump is definitely hyperinflationary, lots of spending, deregulation, tax cuts. Like, we're just gonna, spin out of control, hyperinflationary world. And the first move was the long end selling off almost 20 basis points, essentially overnight on Tuesday. But we never really saw the lows in the long end that we experienced overnight during the trading session on Wednesday. And it actually kind of started rallying, a little grind on Wednesday. And then throughout the rest of the week, rates kept on going to the point where 10-year treasuries last week were completely unchanged. No move at all. And it was because so quickly the narrative of him changed from hyperinflationary guy to like ultimate, like dereg. We're going to find all this productivity gains. Like, we're going to have growth without additional inflation. And, that was 48 hours. That narrative
Right. Elon's going to
completely
fix the
changed.
deficit.
But I'd agree. Nobody actually knows. The fact that like this was the beat the drum, definitely the move. It's going to take place and completely reverted in 48 hours to a completely new narrative.
And that comes back to our golf course conversation with that guy of, well, both are going to spend like drunken sailors,
Yeah.
right? Like, so it doesn't matter who's going to win in terms of both are going to spend, and then it's just what happens to counterbalance that. How do you square gold in that whole thing, Zed? Because, right, it was weird that gold was down at the same time the 10-year was down that night.
Well, I mean, my joking answer is I don't know anything about gold, and my wedding band is tungsten. Even though
You're supposed to say nobody knows anything about gold.
Exactly. That my doctor buddies say that's dumb because if I ever smash my finger, they can't cut the ring off. Like, they'd have to cut the finger off. That's why your wedding ring is gold, because you can cut it off. But I think
Fact for the day, but Zed coming in hot. I love it.
There you
There's
go.
probably some like old British sailing ship background up there. Like, yeah, if you got caught on a thing, you didn't
Smash
want to
your hand.
die. Yeah.
But I think ultimately gold was I don't know, tail risk hedge. And so similar to vol, event goes by, vol gets smashed. Like, I don't need my hedge anymore. The event's over. And my hedge in that case was gold. So I do think that's gut shot reaction that people had it as the, negatively correlated to equities thing in the portfolio. Event rolls off, like equities are happy, get out of the hedge thing. And just for some people, gold was that thing.
Right.
But
But
also,
it's like the real traders are buying 10 years for their inflation hedge, not gold. Yeah.
But you think part of it is like, as you know, we talked about this many times before. It's like gold is an interesting hedge, but not necessarily in the cute time frame you're looking for. Like over, decades or centuries, it's an interesting inflationary hedge, but it could be something different. And then I think Meb Faber was talking about the other day is like, is this the first year in history that you have both gold and S&P up like well into the double digits on the year?
You know better than me. My guess is
I think,
2021, but I don't know. That'd be my random guess.
Sounds like a blog post.
but like related to that though is like speaking of just like these narratives and changes so quickly, what is it, months before the election, Trump comes out as now Bitcoin positive, and talk about just a crazy bull run for Bitcoin this year, and then the last few months, and then even election week, post election. But also, I mean, do you guys think this is just like the exit liquidity for those through those via those ETFs, or the bag holders are now going to be retail? Or
I just think all we know is that the greatest ROI is buying politicians, right? You got Coinbase, like what, 75 million pack, and that stock's up probably 100% in the last month or so, or Elon just doing $1 million a day lottery in your state, Jason.
Yeah.
Leads like 100 billion of personal wealth gain. Like that's good.
You
ROI.
stole my thunder. I had that as a question is why aren't we talking about those guys as activist investors, right? That blows away any hedge fund that's an activist investor. Like what did Elon put up? 10 million and maybe 100 million of his time to make $5 billion? Right. To your point, that's a huge return on investment.
It's shocking how much that if you actually look across the board, like how little you would have to spend to like capture all the government employees on both sides. So it is fascinating that you don't see it even more often. And like I think the people that are a bit of a stretch when they said if Kamala would have won, he would have been in jail and lost his company. So he had to make that bet. But I mean, I think that's a little bit too egregious of a comment.
Oh, I think he knew exactly. Like if she won, there's nothing is going to happen to him. They're like rule of law, and he was fine and whatever. He's got a right to his opinion. And then if he wins, he makes $10 billion. So it was like totally a one-sided trade. But you don't think he's an activist investor?
What do you mean?
Right? We like Ackman and all these guys, we trumpet their ability to get on the board and like change minds and eke out 13% or something on a stock because they changed the board or got this activist stance. And like, here's Elon, like, obviously he was doing it for his stock price and for his own wealth. That's my belief. Maybe he was doing it for his beliefs, but you know,
Greenmail is kindergarten stuff. Yeah, like activist investing is kindergarten stuff to buying politicians. That's a story as old as time, is political graft, right?
Yeah, I guess. But I'm saying exactly. They're kindergartners. This is like AP bio level stuff that they're pulling off with the politicians. Like they should be trumpeted as the better activist investors.
Especially what you found out, like tangentially, all like government jobs in this country, and then tangentially related to government jobs is like 30% of our workforce. So yeah, why wouldn't you be spending your money there?
Last bit on markets and the election here. U.S. has massively outperformed foreign. Jason was sharing with me a chart today or yesterday on since the global financial crisis, since 07, 08. Before that, it was not at all, right? Foreign usually outperformed U.S. And why would that continue with this new administration? Why might not it? Any thoughts on that?
Yeah, I mean, the first move is definitely, pure USA, right?
Yeah.
Equity markets, like as I said, fixed income markets were small rally, right? It's not even like inflationary. Dollar obviously was spectacular, strengthening last week. So this definitely the gunshot move, without a doubt, is more of the same, but potentially even more dramatic.
Right, but like look at if you take it to its extreme end, right? We become China. Everything's totally nationalistic. We're just going to keep all the money here. We're going to do all this. Like at some endpoint, that doesn't work out so well, right? In relation to the other countries, or maybe we're so unique that it does, and we're like, if we struggle, they're going to struggle more. I don't know.
But part of it is the chart I sent you was like historically, for the long arc of history of like stock markets, it's like they have 53% dominance by ex-US global stock markets, where since the GFC, that's only 18%. So it's just having American dominance since the GFC. And then more importantly, like, I knew it was high, but like I keep asking people is like, since 2010, what's your guess of multiple returns for the stock market? Like what has been the multiple return since 2010, if you're invested in S&P 500 only?
What do you mean, like the average annual return?
Yeah, well, average annual return equals your multiple over the 15 years. Like, how much do you think you're up?
I mean, multiples have doubled, a little bit more than that actually, but
No, the multiple it's 10x. Like it's
well, for
your
your return on spot. I'm
right.
just saying,
Yeah. Yeah, you're talking about, yeah, the PE multiple is double, but then the return is 10x. So we're at like a 15% CAGR since like 2010. Like that is an unprecedented run in world history. I knew it was good. I didn't realize it was that good. And I was just thinking about, people that were in their peak earning years, 15 years ago when they're in their 50s and now retiring is like a 10x return. I mean, granted, they probably weren't in SPY only. They're probably in some sort of target date or 60/40 or 80/20. But I find it fascinating. But also the problem, Jeff, though, with this that I, always take umbrage with is that we're talking about a narrative, right? And the pernicious thing about narratives is they're strongest at tops and bottoms. So right now you could tell a great story of American exceptionalism, and it's easy for us to do as Americans. But also, like, part of that story is that, Europe and Asia can't compete with us on AI and the technology front, and this country is going to continue to outpace everybody on both, work ethic and ability to innovate and have the most innovative companies in the world. And all of those sound great when you're telling the story in hindsight bias, but like a lot of times that's right at the turn, right?
Yeah, and it helps that they have that 10x history to prove it, right? Like,
Yeah, exactly.
yeah, because
No,
what's the ex-US over that same time? 2x, 3x, maybe?
Yeah, if that.
no, I do think it's mind blowing that returns the last essentially 18 months have been so spectacular, and it doesn't get much coverage, if you will, right? It's like realized volatility has been basement and returns have been spectacular. Like the only in the last, our lifetimes that are like somewhat similar is 2017, and like returns were less, but vol was truly zero. 2013 was pretty similar to right now. And then 1995 was, basically the best of the best. It was, high 30s returns and like something like an 8 realized volatility. But, this is pretty rare how spectacular risk adjusted returns have been in 2024. And that's obviously after a pretty spectacular, quarter leading into 2024. So we've had one heck of a run. And yet the market's pricing in, very, very little risk. I had to like check it 3 different times because I was shocked that high yield spreads are now 273, which is the tightest they've been since the GFC. And really it was only like a quarter and a half in 2007 that they were tighter. So you're like, and like, 05, 6, 7 spreads were very, very tight due to aggressive securitization, really grinding the gears tighter and tighter. And we're like almost there. So it's like credit markets are saying no risk at the moment relative to history. We have spectacular returns, as we said, and yet everybody now seems to be max bullish. Like I can't find any negative articles about anything.
Yeah, that's the sentiment's the highest it's been in history, right, for bullishness, which, as you know, is a contraindicator. But like your 2 points, that I think we're up like through today up over 26% year to date. But if you go trailing 12 months, it's 38%, and then if you go probably like you're saying 15 to 18 months, it's even higher than that. And yeah, it's just like insane to think about. But I always think the counter to that would be, and like you're saying, credit spreads being so tight, is stability breeds instability. Hyman Minsky, right? Like this is what happens as everybody says, oh, there's no risk anywhere to be seen. And it's, bullish sentiment at its high is like, when does that crash come? But then I also have to counter that argument with going into 2007, 2008 GFC, we had gone 1,400 trading days without a negative 2% move. So like the market can just keep ripping like this much longer than we expect. It's just, we don't know when that's going to happen.
And one thing on your sentiment side, the bullishness on equities, as you say, is basically at all-time highs from sentiment, but bullishness on bonds is also like about as high. It's just like straight up buy everything. Like
well, that's crazy. Given right, bonds doesn't have that past 3-year profile at all. I mean, that's a contrary, right? There, people are bullish on them because they've gotten so beaten down. Question.
It's I think it's, as you say, it's the, I guess buy America, right? It's all
great. Or is it? But Jeff, I think you're talking about like nominal returns and the drawdown, where maybe Zed's talking about, like we always talk about, mailbox money. People just want that income, right? It's like a UBI for the rich, right? If you can afford to hold treasuries, you're getting a nice stable income.
Yes.
Stable.
Here's the Democrats are idiots, full stop. No, but like they should have been trumpeting like, hey, we're at all-time highs. This is the best performance in the market this year and that year. Like no one was talking about that per se. right? Of like it was, or the Republicans were genius of, oh, things are terrible, things are terrible. Ignore the stock market. Yeah, that's only for the rich people.
What does a 4-year bookend have anything to do with global economies?
Yeah,
Absolutely nothing. Yet
nothing.
we pretend like the president has some control over global economies and asset flows globally. It's insane.
Yeah, and inflation, right? Like inflation
Yep.
was all COVID. Why are we pretending it was one party or the other? Let's switch gears a minute, talk what kind of strategies or markets or things surprised you in this year in 24, as I'll mute myself.
Go for it, Jason. You have more
I,
of a
I,
broad view.
I wasn't, I don't know about surprised, right? Like that's the hard part. Like what is
Or
surprising?
you
Nothing.
found
Like,
interesting. Yeah.
I mean, it was interesting. Like, I'll start with a commodity trend perspective, right? Q1, we had the big cocoa trade, and it was interesting that commodity trend following was doing well at the same time the stock market was ripping, which doesn't necessarily always happen, but as an uncorrelated asset class, it does happen over time. But what I think is more interesting about the cocoa trade is that, like, if you have the classical philosophies of trend following, you should have as many markets as possible. But what is interesting when people build trend following systems, a lot of times they'll be like, well, cocoa hasn't trended in 2 to 3 decades. So I'm not going to include cocoa. It's a non-trending market. Well, then right when you needed it at most, all of a sudden cocoa started trending for the first time in decades. So I think that's what I think is interesting, is more surprising on portfolio construction when we going back to this idea of recency bias, when you maybe exclude markets because they haven't performed the way you want to, whether it's convergent or divergent trades, well, that can easily flip and kind of show up right in your face.
The
Yeah,
Go ahead.
no, go for it, Jeff.
I was going to pivot. Go ahead. Come off that.
All right. Well, my pivot was
Yeah.
essentially, to me, the most interesting thing is the risk on, risk off light switch is just flicking even like faster. It's been a pretty consistent theme since the GFC that as soon as there's been, oh geez, there's more risk in the system, and it bleeds out, reasonably quicker and quicker and quicker. But man, August was pretty phenomenal. How essentially the event week, actually markets were flat, vol was down, vol was down, and it's like it just cannot retain any sort of risk off environment from seemingly like hours at this point in time. So I think that was the most mind blowing part,
Do you
is
think
that we're more aggressively leaning even down that tunnel.
Do you think part of that is technology and risk department, right? Of like things are more real time. We have more idea at a hedge fund, at a bank, or wherever of where everyone stands, what the actual risk is, and technology we can either flatten it out right away or
So I do think there's one big structural reason why that can happen, and I think prior to essentially 2010, most of the risk was warehoused in a handful of institutions that all acted incredibly similar, right? So investment banks were the residual dumping grounds for risk. They would welcome that risk. That's how they made money. And they all had very similar, shock profiles and mechanics of how you de-risk and things along those lines. So it's like concentrated holders of risk that had a very similar reaction function was what we were in prior to 2010. Post 2010, they've been kind of removed as the main risk takers, and now the new risk takers are dispersed, and they do many, many different things. They don't have this same reaction function of how they have to remove risk. They have different models. They have participated in different markets. And because it's dispersed around these players with different reaction functions, the ability for when there's that risk off event to have somebody in that ecosystem flick the switch to actually start taking more risk is just very, very, very different. So I think that is the structural change that's taken place from, call it, or the mid 1980s through 2010, and then 2010 on is just
right.
where
But I
that
would
sits.
I would argue those new groups have more skin in the game and they're losing their own right versus the guy at the investment bank desk who might lose his bonus or whatnot, but is
Yes and
in
no.
and he's maybe puking out and but well, it's not my money.
As long as you have the liquidity, right? And not to step on Zed's toes, but like as long as you have the liquidity there, the spreads have widened, so you have a much more target-rich environment. You have a higher P&L in those. As long as you don't get blown out and you have the parameters where you can step in with some liquidity, you're even better off. And almost like to Zed's point, it was amazing to see that was the fastest vol crush in history, from a vol spike. And what was interesting is like even if you look at like Volmageddon, which was a pretty idiosyncratic siloed trade, right? It still took months for the vol to get crushed back down. Technically, I mean, most of it's towards the end of the month, but it still took months for it to trail off, or we're seeing days or weeks now. And do you think part of that related to what I was just saying, though, Zed, is like, those players after the market opens, and we start getting more liquidity coming back in, people are covered those positions, whoever got blown out, then they know they can step right in. And this is a real opportune time as long as they had the liquidity to take advantage of those wider spreads.
Yeah, I think ultimately the mechanics of, we'll call it the new regime, is they have the ability to just say hands off. And was much more difficult for essentially banks to do, right? They have customers calling in like, hey, I need to do this. I need to do this. These guys are not, beholden to any specific customer. So they're just like hands off, let dust settle. Upstairs, they're saying, how much juice do we have to actually lean into this move? And they come with, okay, this is what we're willing to, put to work in terms of risk budget. And then when they get comfortable to do so, they are aggressive. It's not a, slow bleeding into market. It's like, okay, this is our risk budget. What we think is appropriate here, like go. And that, mentality of both being able to step away and then put the foot on the gas versus everybody prior is, risk manager tapping shoulder, like, you got to get out, you got to get out. Like, no, this is the opposite. They're like, all right, we've been kind of just blocking and tackling, market making, doing our thing. And now these are the events we're looking for. Like, how much do we want to put at risk right now to take advantage of, this change in situation? So totally different mentality versus, feeding into the problem. Like they're kind of like crushing the problem to be opportunistic at this point in time. And it's worked so well, right? That risk budget number has probably been going up and up and up, along with those same institutions have been getting bigger and bigger and bigger. So they have the ability to lean into it more. So that'd be my main gut is basically the amount of money at risk that they're willing to put in each event over the last 15 years has only accelerated, both because it's worked well and because it works so well, they're bigger.
Tangentially related to that, do you think, because all of us are entrepreneurs and business owners on this call, I think it's interesting that like, without naming names, but there's a prominent options market making firm down the street from me that was started by 5 partners, but it's all their capital. So do you think part of that is like without having the institutional infrastructure, they can move that much quickly because they just make one phone call and say, hey, this is the risk I'm willing to put on. They say, here's the parameters. They say, go for it. Like instead of having to run up and down an org chart.
No, completely. Like that's what I mean. It's faster and faster because, again, confidence to take more risk increases after you win a bunch of times. You yourself are wealthier, so like the numbers are bigger, and your conviction in doing the right thing obviously increases the speed at which you're going to say go for it.
But so say I'm one of the 4 people listening to this podcast. And I'm like, oh, well, these guys say these guys just come in and support the market and it bounces back. Why don't I, Mr. Retail, just come in and buy those dips? What could go wrong?
Well, you probably don't have the fortitude to withstand being wrong. It's just is probably one of the
Right, but if I
issues.
base it on those guys are going to come in and support the market,
Yeah,
right?
but
They're going to
they're
always sell
not.
the spikes. They're always going to buy the dip, and
But that's
I'll be
the
fine.
nuance I think of what Zed's saying is that light switches so much faster. What we're saying is like when they pulled and pre-market on Monday, August 5th, but then once the market opened and things started to settle down and they saw the opportunity in that set, then they turned back on so quickly and went, and just started taking fistfuls of making markets. So that's what I think Zed's more saying is like they will only turn it back on when they see the opportunity set in their favor. So if it cascaded the other way, they would have all just stayed outside. They wouldn't have made markets, right? They would have stayed on the sidelines, which is why we saw this irrelevant VIX index number is because the bid-ask spreads were so wide and it was skipping over strikes because they just stepped away, right? But like the Zed saying, they can step away quickly, they can step back in quickly, but they may just step away permanently if they don't see an opportune set. Is that a fair way of categorizing?
But also to that point, then everyone turns the off switch. There's no more selling pressure.
It's just you might not be able to survive a week. waiting
Yeah.
for the event to end. And these folks can survive more than a week.
Right. But I like you guys are too in the weeds. I think the nuance to me is nobody understands nuance. So they're just going to be like, no, it always bounces back. The vol always crushes back down. And now it's doing it faster and faster and faster. Just, and even to your point, I don't have to be retail trader. I can be the guy with his own money of like you're saying, of like, oh, last 10 times, this was the best trade we've ever had. Let's do it the 11th time. Or you're saying, and maybe they were risking 2% of their equity. Now they're risking 5. Now, next thing you know, they're risking 10.
Yeah, it's TINA and BTFD. Yeah, from your point, people are going to keep buying the dip until it doesn't work. Stability breeds instability. But yeah, we're talking about the nuance of the market makers might pull away permanently, or they can come back in when they think it's opportune. They're just much quicker. And so, yeah, it looks like as they have found opportunity sets to still make markets, it's been a buy the dip mentality where that can easily change.
Well, but maybe, yeah, I'm arguing that maybe it can't. Maybe we've entered a new normal where, right, they can come in, they have the quickness to turn off the switch. They don't cause that cascade, and then there is no cascade because nobody's causing it, right? Absent some huge, whatever, 9/11 type tragedy or something's happening where every mom and pop person is selling also.
Yeah, but I think we'll call it Feb to March 2020 waterfall as a good example. Like I think they were, the market makers in general were a big stabilizing factor the latter half of February, and you'd even argue kind of like that first week of March. But then they're like, man, this is not a snap recovery here. Let's adjust the playbook and the risks that we're taking. And then you saw things go actually haywire the next couple of weeks.
And then
if you were just random retail guy, like you're probably gone by the time we get to May 1st.
And
Yeah.
Jeff, in your scenario, it's not the market makers. It's that everybody is fully risk on and yields are getting compressed. So they're taking more and more leverage to get the same amount of yield. And then now the panic happens so quickly, they have to really reach for those hedges. And that's what explodes the value of those hedges, not necessarily the market maker stepping away.
Related but different. Do you think I'm already seeing it? We're already seeing probably all of us seeing it, right? One, you have all these mutual funds with alternative income, which is just selling options. Two, more and more option selling strategies, hedge fund strategies are coming across my desk. Like, look how good we've done the past 3 years. And right, we started in 2021. We have a Sharpe of 6.4. Like, how does that end?
So, same as it always does in tears.
Yeah. But do people need to be more cautious, or right? I'm kind of going back with this time's different theme, maybe. Right.
So
And that's what those guys are pitching of like this time's different. We can use zero DTE, we can do quick hedging with this and that.
Right. So I think one of the biggest misnomer for we'll call it that broad category is that they're short vol products. Like the risk that they're taking in general is the main one is not short volatility. And as these iterations of products have evolved, it's become less and less in terms of their overall risks they're taking in the short volatility category and more in the long delta and essentially selling skew, jump risk, anything in that category. But very few are selling volatility, and very little of the actual risk taking is in the volatility camp, right? Because like you're trying to
be a little more specific on that for my buddy
what,
George at home.
Yeah. Like the purest, short volatility type of situation would be selling like 5-year variance. Like we're truly harvesting implied volatility versus realized volatility. We're selling volatility. What these things are doing in general is selling, we'll call it at the money, puts and calls. They used to be doing, maybe a little bit of 3 months, probably mostly 1 month, and now it's 1 week, and now it's 1 day, going along that trend. If you're selling a 1 month put or call, the main risk in there is the 50 delta. Yeah, it's actually directional is the number one risk that you're taking in there. And then 1 month, we'll call it half and half, short volatility and short jump risk, something like that. But as you get closer and closer to
it'll go right into the money, and then you just have long future on,
Well,
basically.
exactly. The point is like the main risk in these things is delta.
Yeah.
And as you get shorter and shorter, you're shifting more of that short vol risk towards jump risk rather than short volatility. And delta is a almost increasing component because a one day option is binary. It's either a 0 delta or 100 delta. Like that's the main risk that you're ultimately
Yeah.
taking, right? So it's delta, then jump, then implied volatility matters a little bit for what the
Yeah.
pricing of that option, but that's not the risk. That's not the if one day option implied vol goes from 10 to 100. Oh, there's 1 hour left on that option. Like you're not even going to see it in the price. Like that's not
Right.
the risk that you're taking.
Maybe we need to change our terminology to selling risk versus
Yeah.
buying risk instead of selling volatility.
Well, I think maybe let me say it another way because I think one of the nuances Zed was saying before. I mean, let's exclude zero DTE for a second, but let me say this back and see if I have it right. Is like historically short vol trades, right? Let's just say a simple like they were selling deep out of the money wings or something, right? And they're collecting that premium. That's a pure short vol trade. But now you're saying people have long beta that then they're selling covered calls or they're collaring, et cetera, or hedged equity that they're just foregoing their future income, so to speak, for income now, right? And so you're saying that that is a much more slow grind of losses where it's more the whipsaw losses where they get the pin risk on the way down and on the way up. And then people will be like, well, this underperformed my S&P positions over a quarters or years. And that's what they're going to take it off. Where if you had a pure short vol position, you can blow up in a day.
Well, I mean, short, if the risk you're taking is short volatility, your P&L should move based on implied volatility changing or your every single day realized volatility being more or less than the implied volatility that you sold. And essentially none of these products care about changes in implied volatility. That's not what's driving the P&L, nor necessarily the realized on a daily snippet versus implied volatility. It's delta or it's jump risk. So delta, obviously, we'll say like 50 delta, like the fact the market goes up every day. That's what's causing you to make money. Or your risk jump. Oh, you're August 5th, your delta went from 50 to 100 like that because you sold jump, not necessarily volatility. The last year, realized volatility has been lower than implied volatility. Selling volatility would have been a profitable position, but essentially the ultimate numbers in we'll call it a productized world, meaning where people care about notional, are too small. They're not exciting profit
You got to
numbers
put
in
up
a
too much.
notional based world. Right. So it drives everything towards taking more and more delta risk and taking more and more jump risk because those create bigger numbers in a productized, i.e., notionally driven world. Yeah,
And
because like if you were selling 1 year, true volatility, so like a 1 year variance swap, the notional amount of risk that you would need to equate to just selling, again, we'll go to the extreme, like one day at the money options is 5, 6, 7 times, like from a notional perspective. That would be like the risk equivalent. But that's just not how products necessarily work. People get really fixated on one-to-one, and so thus we've ended up in a world that's selling a lot of jump risk and taking a lot of delta risk, but not really selling much volatility.
do you think those take out the beta components of those products? Do you think their option strategies are terminal break even? Like as if I was just selling the volatility naively back in the day? Right? Is it collecting, collecting, collecting on that risk until it doesn't? Then you lose everything you collected.
So where these things go haywire is actually more of a like December 2018.
Mm.
Because again, like the products are built in like a notional landscape, right? So it's like, market goes down 20% tomorrow and it's only down 18%. Like that's
We
viewed as
won.
that's a win,
Yeah.
right? It's
Yeah.
like it's not great,
Yeah.
but like, hey, like that's fine. It's gappy moves with some chop where you have the hey, I lose 3% Monday and Tuesday I only make 50 bips, and then I lose 3%, Wednesday, and then hey, I only make 50 bips Thursday on the recovery kind of thing. And you keep doing that over and over again. And you're
Mm.
like, whoa, December, like the market by the end of it was, only down, 10%. I'm down 20. What the heck happened there? Now that
Yeah.
is the problem. Like it's it's gappy moves with some chop, likely over a shorter time period, so it really jumps out to you where you
But they
actually
know that's
underperform the market.
a 1 in 20, 1 in 50 type month years, right? So the productizers are willing to take that risk. Like, we have this small
Except for
risk of
this,
this kind of move happening. Let's take it.
that's how it initially starts off, right? But then everybody piles into the trade, and now you got to bring your strikes in tighter, right? So then you just change the probability distribution, right? And then,
Yeah.
like Jeff, you're just saying, like, basically options are zero sum over the long term. Yes, but there's tertiary effects of rebalancing. What's the rest of your book look like, and are you hedging your external business risks and other ways of looking at it?
Yeah, I mean, listen, like I guess 18 is like the fun year for all that stuff, but like the vol again in February 2018, that was essentially a we'll throw everybody in the basket of like people that essentially try to harvest skew or sell skew. Like that was them. Like that's their really really bad outcome. But that's tough to put in like a non LP type of product, right? So like the product people are very notionally driven. You can't really sell harvest skew in a notionally driven world. It's like again, just like the potential return numbers are not interesting at the end of the day. And so where you get problems in the productized world is just that like if we just went up and down 2% every single day for like 30 days and the market's completely unchanged, the product world people are not doing well. And that's when
Mm.
everybody goes to like, what the heck happened? Like the market is un and I've lost a lot of money. Like that's
Yeah.
confusing. Like you told me my
Which
risk was notional 1-to-1. Like how did I lose more than just owning the underlying risk?
which a way to think of that is if I'm delta hedging that constantly, right? I'm losing on my delta hedge on both sides.
Yeah, no, and that's why most of these things back before, recent world kind of did the 1 month don't do anything. Like
Mm.
there is a reason why the largest hedge equity product out there does longer iterations and doesn't touch it because they may or may not win or lose the coin toss at expiration, but they can't get chopped up, which is ultimately what ends these
What
products.
looks worse on the marketing brochure, right?
Yeah.
And then but to also distinguish that, I think what you're saying too that's interesting is like you can't build up enough of that like skew harvesting or whatever to be too big to fail, right? It's always going to be a small product and a niche product. Where these products, it's really death by a thousand paper cuts, right? And by going quarterly or whatever on the rules, they've extended, so it's more of that slow bleed out before as people slowly rotate out of those products because they're not performing with line with their expectations,
Yeah, like I
right?
mean, like obviously the main one in December 18 was the Iron Condor folks, right? It's like, hey, this is meant to be you know 2 to 3% yield enhancement to your portfolio, and we're selling put spreads, call spreads, meaning like the max risk is whatever the difference in between those strikes are. And you're like, yeah, that's the max risk for like that iteration, but you can do that time iteration of a week, a month, whatever the rebalancing schedule is, infinity amount of times as time goes on. And so that's how you end up in those situations where like, well, they rebalanced or things expired. Then you did it again. Well, you lost that tranche again. And you lost that tranche again. And that's where the chop really just eats the notional style products, and
I'm just
alive because they just lose more than the S&P
yeah.
500, which everybody thought was like the max possible worst case scenario.
And my brain just goes to like an article in 4 years of like, well, Mrs. Smith didn't know she was selling
Yeah.
jump risk and
Yeah.
this when she invested in XYZ alternative income fund. She thought they were like loaning money to teachers or something. I don't know, right? It's like that's the big disconnect for me of like what they're calling it, marketing it versus what's actually happening under the hood. It seems to be a pretty wide division there.
And either way, Jeff, you're gonna look like an a-hole, right? Like when you're saying
Yeah,
before, like warning about the returns of this, then everybody's going scoreboard, we're crushing it. Why don't
yeah,
you shut
yeah,
up? And then after the fact is like, are you stepping on Miss Smith's neck after this? Are you calling her an idiot? Like, how dare you?
yeah.
Like this is not a good scenario to even be talking about.
We talked what interests you, which we got into. What about what sucked? What kind of strategies? What things were like really poorly performed poorly in 24, right? Like any in your world, Zed, dispersion, skew, any of that stuff?
No, I mean, what was not fun was essentially the last, we'll call it 8 weeks. because implied volatility again was extremely elevated, realized is basement. And, there's not much to do other than, do your best hand fighting to acknowledge
Right.
the fact
Realize
that,
needs to do something to get
yeah, they,
you.
they, they acknowledge that, like, yeah, options are just too darn expensive. And we all know why. And we all know that's going to stay that way until it rolls off. But, hired to do a job. And so you have to still keep trying to do the
Yeah.
job the best you can. So yeah, that last 8 weeks was not fun. Very happy to be past
And we
that.
already talked foreign versus US, value versus growth, right? The Russell had a few crazy big moves, but overall, right? Nobody cared.
I mean, you had that in your like notes of things to talk about, and I'm like, I really pay attention overly. Like the narrative is growth is better, and
Yeah.
I just went to like a couple random indices. But I think more than anything, it just screams like this was just an
Nvidia.
awesome year. Like,
Yeah.
you can't lose anywhere. I mean, like whatever value index I picked, they were all up between like 20 and 25%. Like, yeah, the growth stuff was like pushing 30, but you're like, man, like the bad thing was up 20 to 25%.
And I always wonder, like, it's not even like growth versus value, Jeff. I think the overarching thing is more rotation and pod shops. And that's when you see those big spikes in a day, like on a Russell or something like that. That's to me, it's more like rotation from, these pod shops or whoever's trading faster. And that's what people then assign it to growth versus value. But that may be a misallocation of what actually happened. The other one that absolutely sucked this year, and Jeff, you have a long history of this, is like commodity trend following, right? For all of the returns you can
You
get from
just
that.
said it was awesome with Coca. Yeah.
Yeah, it was great Q1, but then you have the commensurate drawdown. So this is why historically, it's going back to even what Zed said about you can't, you know, th- things, that can accumulate large size tend to accumulate large size as the good times roll. But that's why maybe you have never seen truly large size in commodity trend following because most of them have MAR ratios of 0.2 to 0.3. So you have to take these commensurate drawdowns a lot of times after you have good years, and that keeps money from plowing into them a lot of times because they take some pretty sharp drawdowns, and it can be quite painful to hold that asset class.
And you mentioned pod shops there. Let's touch on that real quick. I know you've talked and interviewed a lot of them, Jason. Right? If all the retail money's flowing into alternative income, it seems all the institutional and professional money's flowing into pod shops and that model. What what do you like? What do you dislike about that model?
There's a couple of things. One, we're actually starting to see outflows this year. So this is the first year of outflows since 2020 in pod shops. I think it's still de minimis. But I wouldn't put too much credence in that. What I think is interesting and not interesting about pod shops is the actual pod shop model has a sustainability and survivability to it, but I'm not sure there's that true alpha that they believe with the PMs below it. And what I mean by that is, I've talked to some of the best, people in the analytics that have really analyzed different PMs for pod shops. And even persistency of returns or the persistency of this alpha they're trying to use with their, individualized benchmarks, they will limit it to like 2 to 5 years of just one regime because as soon as they go into more regimes, it looks like that they have alpha decay. So I'm like,
Mm.
yeah, of course they do. So why would you do that? But then if you think about it from the 30,000-foot view of the actual pod shop, and you're cutting 50% exposure at down 3 and then 100% down 6, and then you're replacing them like Lego pieces, that's how you maybe get the returns from these pod shops continuing to move forward, is because it's more about the emergent portfolio aspect if you get with running hundreds of pods versus do these individual PMs, do they actually produce alpha in some sort of sustainable manner? I'm absolutely dubious of that. And then the other thing that makes it exceedingly difficult is after 2020, when you had all this money flowing into pod shops, and then especially in 22 and 23, is when they're spending $50 million bonuses to get these PMs that they think have alpha over the last 2 to 3 years, is that likely to be persistent? And how much does that detract? And then eventually, when they've had these like kind of lower single digit returns, you see the institutional allocators getting upset because then they start looking at those pass-through fees, and now that becomes a problem. And instead, when they're putting up double-digit returns.
Zed, thoughts? You've been anyone
No, I
tried to
mean,
poach you and put you in a pod shop?
I was gonna say, like, I mean, we'll call it rise of the pod shop was one of the reasons I left being at a hedge fund in 2013. For the first, call it 6 years of my career when I was at a long short distress hedge fund, like we had serious edge that we can enact and like, did well. But post kind of 2010, 2011, really came to the conclusion that if you weren't massive, it was going to be really difficult, just really difficult, because you had to focus on not only like, what are the potential risks that we can take, but how do we get out of these, because our capital base is not going to be stable. Like, you just had to admit that unless you were massive, like, your capital base was going to fluctuate, which then drove you into less and less attractive positions, knowingly so, because you had to worry about operating the business side of investing way too much. And along with that, obviously, you get less favorable terms in terms of ability to access various leverage and things along those lines. And I just came to that conclusion after kind of 11, 12. I was like, I don't think, unless you're at a behemoth, the hedge fund industry is going to likely be successful, no matter how great you were as an investor. So it drove you to you had to go to one of the behemoths, like. And I think that is the attractiveness of the pod situation, is it allows you to, in theory, have somewhat of a stable capital base and things along those lines. But now you're like, I got my risk overlord as an individual, pod within in the shop. So it's a different type of instability of capital. But yeah, no, it's not surprising to me. Like, this is where things ended, if you will.
Yeah. My signal, it might be the top for pod shops, is we talked with a group the other day. It's like a cottage industries formed of finding those traders and getting them out, right? That the pod shops are hiring these groups to go in and kind of like pod recruiters, essentially. Which I'm sure has always been there, but it seems it's more focused on that trader aspect, than someone, right? These people aren't on LinkedIn. They're not saying they want out, but they're being recruited to get pulled out. Last thoughts on what could be in for the year ahead in terms of Zed, in terms of vol? We'll finally see some realized, who knows?
Yeah, who knows there? I think the main thing I'm focused on for 2025 is the return for rates actually being in focus. I think the long end of the Treasury curve is going to really tell you, like, what is going to be the game plan for most asset classes in 2025. And it's of course, it's like, nobody cares about inflation anymore, so that's gone. We've had our like backup and treasuries, but it's like, oh, we're hanging out at 4, 3, and 10s, like we were at 5 like a year ago. Like, this is all good and fine. So I think everybody's really ignoring the concept that your discount rate matters for the fair value of any asset class. So to me, it's 2025 is, can rates kind of remain in this lazy mid-4s range, or do we actually get some significant shift? And I think that'll be the main driver of risk in 2025.
And for me, Trump, as a real estate guy, he hates high rates. He's going to be like, lower, lower. I need to get, right. Everyone know my real estate friends needs to get these deals done at low rates.
Yeah, well, I think that's a funny one, because everybody obviously, Powell leaned into it last Wednesday from the question of, like, oh, like, can you be fired? And him being like, no.
Yeah.
But I mean, like, these guys gonna be like friends this time around? Like,
Yeah.
they didn't like each other because he was raising rates in 18, right? Like, he's in rate cutting cycle mode. They're gonna be friends.
Yeah. It was weird they didn't give him like a 50. I mean, I guess he gave him a 25. Yeah, but to me, there's no way that Trump would want or allow higher rates. Then that's a whole nother question whether he has that authority to control that. But
Yeah, and I mean, again, like, the longer end they have less control over is
yeah,
the real answer. And long end holders are kind of topped up. I mean, the pension community is already kind of de-risked, so like, there's nothing additional to buy. Insurance, yeah, they sell more product, they need to buy more duration, but that's not an overwhelming move. It's like a GDP growth type of situation. Sovereigns don't really are not exactly excited by US paper. And at the end of the day, like, what stabilized rates a lot was actually retail wealth, anything in that like channel, like actual taxable investors were decent buyers of duration in 23 and early 2024. And I think it's as simple as, as Jason says,
Jason,
hey,
yeah,
we got a bunch of older folks with a lot of money that got brain warped by zero rates for a long period of time, and so they viewed 4 as like, wow, that's amazing, like let's go ahead and lock it in. But like that's kind of one time ish of an adjustment. And then 2, I think the messaging for those folks is actually shifting, not even necessarily like FOMO, but I think they forget that you pay taxes at an income rate on that 4%. So the whole like, geez, these darn treasuries made me get a really big tax bill this year. Like, it makes it seem a lot less attractive. So I kind of think the natural home for all this paper that we know is coming down the pipe, there's not a lot of places to stash it. So
isn't there an ETF for that now where you can buy? They give you basically the T-bill rate without taxes.
Let's not. That's debatable on whether that's going to carry into the future. So let's not point that out. But as Zed and I have the eternal debate, is like, I don't think people care about taxes more than they care about mailbox money. They just care about getting those checks, and then they'll worry about the taxes later. And then, Jeff, I'll play your game. I'll throw you out 2 random bones for you for the future. One was I heard Jared Dillian say this the other day, so maybe some other people have been saying, is like his conspiracy, or maybe it's 2% probability, is that Biden steps down now and Kamala goes ham or YOLO for the next few months, and that just throws a wrench in everything. So I thought that was interesting.
And then we could get our first female president.
Yeah, there you go. And then I would go, the other one out of the blue is I'm long Tri-Tunes right now. If I've seen anything, is like these boomers have a lot of discretionary income and they love Tri-Tunes. So
I think you're late on that, but because that Bentley or whatever the B name that one big group sold to Barrington, they sold to Sea-Doo like 3 years ago. So you might be late on that trade, but for sure, they're like, oh, I have a double decker, I can turn it 90 degrees with a skier on there. I'm big on that myself. We're going to nominate some Mount Rushmores for food. This is really your guys' favorite topic, and as Jason alluded to, we told him to come on and then we talked about food. So Zed's my go-to here in Chicago. Like, hey, I've got. Not only does he have good restaurant recommendations, he can give them specific. I can be like, hey, I got some college friends coming into town. This is the vibe. Oh, I've got my old physics teacher coming into town. We need this vibe. I've never had dinner with my old physics teacher, but you get the point. So Zed's good at that. Then Jason is well traveled, knows little dive bars, knows fine dining, knows everything. So let's just do. We'll start it off with I borrowed this from Bill Simmons, right? Instead of like, what's your favorite? He has you do a Mount Rushmore. So then you get 4, right? Instead of just having to pick one, who's better, Jordan or LeBron? Michael Jordan, obviously, but fine. They can both be on Mount Rushmore. They can both be up there, and then we can argue who's up there. So let's start with burgers. We'll do back and forth. Everyone put one on the Mount Rushmore, or you can each have your own Mount Rushmore.
I'm excited to see how much Zed and I cross over. I think there's at least 2 places we're gonna cross over, but Zed can start. So we're just going one each to start.
Yeah, one each. You each get 4, but one each.
Geez. All right. So to me, the best burger is without a doubt the Black Label Burger at Medado Tavern in New York.
I knew that one was the first crossover we were gonna have. Right there. Yep.
All right. I've never had it. All right, I gotta go.
I gotta go off of McDougal Street.
Yeah, Minetta Tavern. I knew that was that was one of my guesses that we are gonna have crossover. So seeing how you went more you went outside Chicago for that one, I'm gonna steal a Chicago one from you, and I'm gonna go Warlord.
Concur. That thing is. I went back there the other night. Ooh, boy, that thing's good.
Jeff,
but
you got one?
Zed's had that, and you put it above. You put the Black Label above. And what a great restaurant name, Warlord.
It's the best name.
Yeah. Zed, you're next.
So you're not going on this, Jeff? Are you not participating, Jeff? Is this just?
I'm not participating. Yeah, it'll take too long.
So I'll go a weird one because it's the Hog Salt family, but it's not Cheval. I actually think the burger at Armitage Ale House is spectacular.
That place is blown up. People are like, let's go to Armitage Ale House. All right, Chicago. We got 2 Chicagos. Jason?
Yeah, it's hard to beat hog salt. in everything, especially even al shabal. But I'm gonna start with a hot take. I am not a big fan of the smash burger craze. I grew
Mm.
up on like thick, juicy burgers with like rare in the middle,
Like the Eddie
that
Murphy,
yeah,
Mama, I want McDonald's. Yeah.
yeah, like the Wisconsin sharp cheddar, some good Dijon on there. Like get your ketchup out of here. Those are what tomatoes are for. Like I just am not a smash burger fan. But that said, I have to give a little shout out to my boy Chris Costow at Charter Oak in St. Helena, Napa Valley. He has one of the best smash burgers in the country. And I'm sure we're going to get this later, but there's nothing like a three Michelin starred chef going down market and trying to create the best burger on the planet.
Burger. Mm,
Jeff,
love
you
it.
had that, didn't you, when you were there or no?
Yes. I don't know if I had the burger, but was there.
Uh,
I mean, I'll just throw in Oshvalk because you guys mentioned it. But
yeah.
you're saying the Armitage Ale House is the same family? I didn't know that.
Yeah, they're hog salt, but I'm telling you, their
Yeah.
burger's a little different than au cheval, and I actually think it's a better rendition of the smash burger
And I
than au
ruined
cheval.
Jason at Ocheval when we were there. What did I say? I'm like, I don't like cheese, and it's too cheesy. And it's all he could think about was the cheese at
But I
Ocheval.
do try to stop at Small Cheval every time I'm in Chicago. So I'm a big fan of Al
It's
Yeah.
Cheval.
very good.
They redid that one near you, Zed. It's like easier to
It's
get
got
in and
the
out of
yeah, and it's got ice cream in there because
there.
they took over Mr. Freeze, and so
Love
it's
it.
like it's now your like banana split old school ice cream shop and small cheval.
All right, we're moving on. Fine/great dining. Fine dining, great dining. Worldwide.
Hold on. I got one more thing to say about burgers. This
Yeah.
is it's all nuance, right? Like it's your burger to bun ratio. It's a lot of little nuances because like even like Kennard in Portland does an amazing like steam burger, but they're like steam sliders, and they use King's Hawaiian buns. But
Dean.
like
Yeah.
but you gotta get like like the meat to bun ratio has to be just right, and that's what I'm saying. Sometimes the smash burgers don't quite get it. So I'm just airing my grievances with the
Especially
general
without
pat.
cheese.
Yeah, it's
Let's
tough.
one favorite fast food burger. Steak and Shake. Five Guys. I don't
Probably
like
Five
Five Guys.
Guys. That's all right. Five Guys, all right. I'm not in and out, even after living in California for 15 years. In and out is like, yeah, it's better than McDonald's or Burger King, but in general, it's kind of
My problem with
garbage.
Five Guys is I think their fries stink.
Yeah,
Mm.
too
It's
thick.
hard to me to like lean in on the burger because of fries.
All right, great/fine dining. Worldwide. Jason, you go first.
So, and maybe if we go back and forth, that's just too much. It takes too much time. But like, I think about Blue Hill at Stone Barns in New York is one of the best dining experiences I've ever had. Another one semi-related to that on this fine dining three Michelin star side is the French Laundry's back. The French Laundry
Mm.
probably spent a decade going down, and it is back with a vengeance in the last few years. It's really crushing it. Obviously, there's tons of choices in Chicago, but I'll leave that to Zed. But I will say what's interesting, I thought when you posed this question is like fine dining, great dining is like I think we may all be in agreement here. There's nothing better than three Michelin star quality service execution, but done in like a Bib Gourmand style, right? Like just where you can go in there casually, jump in there, jump out, just order a few things, get the hell out, not do 23
Yeah, I don't have
courses,
a 20.
like
Yeah, exactly.
I don't know. I'm like Bourdain used to write about that in his older age. It's just like I'm not interested in that kind of death march marathon anymore. So it's really about how do you get that high quality execution in a casual setting where you can just order a few items and have a drink and go. And that's why I think like the places like Charter Oak that I mentioned earlier, there's like dozens of places in Chicago we could put up there, and that's more Zed's domain. But it's just trying to find those little spots these days. That's more on point. It's almost like Jeff Reverence, what Zed talks about is like you got to know like what kind of vibe you're looking for. You can't just recommend random restaurants. It's like who are
Mm.
you with? What's the night about? Like all of those things truly matter.
Yeah, so I'll go shotgun blast
Re-
to like
Real quick on the
yeah,
courses, real quick.
go.
We're going to Barcelona for Thanksgiving because nothing says pilgrims like the epicenter of Catholic persecution. But anyway, my wife's like, "Hey, do you want to go to this? It's Michelin star. It's a little expensive, but it's only 10 euros per course, I think it comes out to. So it's pretty good." And I'm like, "Oh, that sounds good." But like, how many courses are the kids? She's like, "Oh, there's only 27 courses." So like, what, 270 euros per person with the kids? No, we're out. We're done. And also the time of that, right? Like, how long does it take 27 courses? Anyway, all right, Zed.
Yeah, so it's both of you guys are leading perfectly into my list. So the relaxed, amazing dining that I hit a decent amount in our neighborhood is Schwa. I'm a huge fan. Like, been around for probably pushing 20 years now, to be honest.
I haven't been there in like 10. I got to go back. All right, Schwa.
But still BYO,
Mm.
just spectacular, different every time, French, leaning, but yeah, and can't beat the environment. Very unique there. I think weirdly the best specific fine dining meal I've ever had, which is a rarity for these types of restaurants. But man, probably 10-ish years right when Next opened,
Mm.
they did an ode to El Bulli because El Bulli had
Mm.
just closed, and Grant had worked at El Bulli early on in his stint, and so he, got access to the full, 20 odd years and did the best of. And I think they did one course per year that El Bulli was open, and they just nailed it. Like they actually had a lot of the El Bulli staff flown in to, so it was like, this wasn't people like making their dishes. It was like it was the right folks doing it all. But that was probably like the most out of this world meal
What
ever
and
had.
for Next in Chicago, brilliant idea. They change the theme every 3 months or
Yeah,
so,
3 or 4, something like
and you
that.
buy
Yeah.
tickets to it. So it's. But my problem with Next always is they should change the decor also. Like I think everyone would pay 10, 15, 20% more on their bill if you totally changed the
New restaurant.
restaurant. Yeah, every time you came. And then it's right. And one time was your mom's food, your room as a kid, like 1926 steakhouse, right? And they have dates and times. So you're not only a type of food, but like
Full
a date to
experience.
it as well, which is cool. Sorry,
Yeah.
interrupted you.
Now, Quintanilla in Mexico City, we thought was
Oh,
absolutely out of this world, spectacular. It was better than Pujol. Pujol was a much cooler restaurant in terms of your decor there, Jeff.
yeah.
But Quintanilla was spectacular. The best dish was this duck confit tamale that
Mm.
my wife Neve, after it came out, was like, that was, so good. And the guy was like, oh, do you want us to bring you another one like at the end? Like we're gonna, go through the full sequence, but like, do you want like an extra dessert of basically a duck confit tamale to go? And we're like, yeah.
Yes, please.
And
Yeah.
they sure enough did it. It was great a second hit. And then now this is gonna be completely unhelpful, Jeff, but there's a mystery restaurant that I've never been able to find ever again in Barcelona.
Ah,
And I can
thank you.
tell
I'll
you
go.
it's near the nightclub Sutan, like 2-3 blocks away. I'd say like southeast. I've been back to Barcelona many a time, can never find it.
Oh, well,
But
if
we
you
were,
couldn't find it, how am I gonna find
you
it?
never know. Just look for
Yeah.
a random tapas place. But we went to the Hotel Arts in Puerto Olympico. We went to the front desk and we're like, where should we go to dinner? And she tossed out a bunch of like BS tourist places. We're like, no, 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 no. Where would
Yeah.
you go to dinner?
Yeah.
And she's like, okay, like really
Over
tough,
here.
but I'll phone call it in. She just literally called us a cab. We got in a cab, get to the place. The guy just had, post-it notes, of reservations, if you will. And it was me and 3 buddies, so 4, loud Americans crashing their bar, waiting to get seated. And because we were so annoying and annoying the locals, they sat us quickly rather than 2-hour wait that it was supposed to be. But we ordered the entire menu. At the end of it, they're like, "Do you want anything else?" And we're like, "Run the whole thing back." Like it was
Do you want
so
anything
good,
else?
like
Yes.
so good.
All of it. Yes.
Times two. But I'll reiterate what Zed said. That's fascinating. Is like Mexico City is arguably the best food city in North America. It's so good. It's ridiculous. And you can get all types of food, not just like Mexican cuisine. They really hit on those things we were talking about of like really high execution with very casual environments. And,
Mm.
like the weather, everything's amazing kind of. And they source the ingredients from all over Mexico and all the different regions. So it's hard to beat that. The one I forgot to mention, because you think about you guys, homers in Chicago, is Curtis Duffy, who's now at Ever. When he was at Grace, that was one of the best meals I've ever had when we were at Grace. Like he can execute with the best of them. And then seeing how you go in all this Homer Chicago stuff, I have to give that shout out to Philadelphia. Is arguably the most underrated food scene in America. More James Beard award winning restaurants than ever before. I've taken Zed out in Fishtown. I mean, the density of restaurants in Fishtown, from Eastern Mediterranean to it's the best Thai food in the country to the best pizza. And then Frysat Sun is my like penultimate restaurant for that, like really high Michelin starred upstairs, but then you can sit at the bar and eat downstairs, and it's just absolute perfection.
Do you think that we've lost in America? Like, there's no longer right? I get off the exit, taking my kid to some baseball game. In between here and Indianapolis, maybe a bad example. There's really nothing between here and Indy. But right, there's not like a little local restaurant with some good food. It's like Applebee's, Chick-fil-A, right? Like the
Cracker Barrel.
yeah, the lower budget stuff is all now exactly the same. So to get that real true flavor of a city and all this, you need the fancy, you need the fine dining, the expensive stuff. I mean, maybe you can say dive bars and that stuff still holds some stuff, but I don't know. To me, that's where if you really want that flavor of a city, you have to kind of go upscale.
Yeah,
Jason
that's
would
probably
be,
fair.
yeah.
That's probably fair. But the nice thing about that though is the diaspora from places like New York City and LA and Chicago is like when rents got like too high pre-pandemic or during the pandemic, a lot of these chefs went back to their hometowns. So now
Mhm.
those smaller tertiary cities have just amazing food cultures because people were trained in major cities and came back.
And neither of you are putting Alinea on the list? Too stuffy?
I really like Olivia.
Yeah.
It's not my top four though.
Yeah. All right. Fair enough. All right. If there's anyone still listening, we're now going to do dive bars quickly.
This is where the crossover is going to happen. I'll let Zed go
Yeah.
first. I don't want to steal his
Oh, I don't
thunder.
know. I lean in heavy Midwest. So my number one dive bar, because it's the place that makes me happier than anywhere probably in the world, is the Buck Snort in Northwoods, Wisconsin.
Oh,
Because my
nice. Great
annual
name.
snowmobiling trip, that's always our first stop. And you go in there and you get a Bloody Mary with like, two bratwursts and a wedge of cheese in it, and it's just very happy place. Locals, I love Archie's, Chippin, Innertown. I probably hit up Lemmings the most due to ease near daycare, but really good locals. And then like, Best Intentions, I don't think I count
Ah,
it really as a dive
ah.
bar. It's on the edge, but also a very good burger, Best Intentions. And then like you almost need like a whole new category for like slashies, Jeff. Like,
Mm.
like are they actually dive bars or like probably not. Like they're their own unique specimen, whether it's,
I don't, what is a
right liquors
slashy?
or Olas or
Yeah.
Marias,
I swear Zed made up this word. He swears it's
Yeah,
a
what do you mean
Chicago
a
word.
slashy?
where it's packaged goods and a
Oh, got
bar.
it.
Yeah.
What's the
Slash.
famous one where they still smoke here in Chicago on the Milwaukee
Well,
and
Richards, I don't
Halstead?
know if you would
Richards,
qualify
yeah.
that as a slashy. Like you could go in there and buy a
He's
sixer
got
if you
that little
wanted,
cooler.
but
Yeah.
yeah.
So,
Never closed during the pandemic.
Love
so
it.
this is the hardest part of this question. Like I knew Zed and I would have crossovers with Best Intentions in Chicago, but like, is that truly a dive bar, right? Like if you take a dive bar and then you
Pretty
make it,
divey. Yeah.
yeah, but you make it great cocktails and great food, is it
Yeah,
still a
true.
dive bar? Or are
Yeah.
you going there to like, get your Mick Ultra or whatever it is? I mean, like that's
That's a good
debatable. Like,
question. Right. The ambiance feels like a dive bar, but the service, the
yeah.
food, and the drinks are not dive barish. Good point. All right.
Right. So if we can cross over into that, you can forget about your entire Mount Rushmore. The best dive bar in the world is Ernie's Tin Bar outside of Petaluma, California, that Zed's
Yes.
been to as well. Like it is
We've
the
all
best.
been there. I agree.
That
I
is
tell people
the
about
best
that all
dive
the time.
bar.
Yeah.
My one B would probably be Best Intentions if we're going that. But then there's a place in East Austin called La Perla that's the true dive bar. Let's like you get like a Mick Ultra with Tabasco on the top. When you open it up, the Tabasco falls in. Like it is truly a shithole dive bar, but it's phenomenal and it's surprising it's still there as everything that's getting torn down in Austin. And then I'm sure, yeah, throughout the Midwest, there's just tons of great dive bars. But it's even surprising, like I was saying, Ernie's Tin Bar in Northern California. Northern California, because it has all those old roadside bars from the 50s. To your point, Jeff, about you can't pull off the roadside. Where in Northern California, they still have great roadside restaurants and dive bars. Like
All
there's
right.
like this place called like Thompson's Corner Saloon in Cordelia, California.
By
That's like
regulation or no? Like, are there other places not allowed, or it's too sparse? They don't have the
it's
footprint
probably
there.
they just stayed around. I don't know why,
Yeah.
but like you can find shockingly good like roadside restaurants and dive bars still in like Northern California.
I love it. All right. We're gonna leave it there. Any last thoughts? Go to a dive bar. Support
Yeah,
your local
exactly.
dive bar.
That's right. Support local restaurants and dive bars.
Yes. That will keep inflation in check. And then you won't have to buy the heck out of your tenures. All right, thanks guys. This has been fun. We'll see you before then, but virtually on a podcast. We'll see you next year. Um, this is it for the podcast for the year. We're going to take off Thanksgiving till after the new year. So thank you guys and listeners. Have a great holiday season. Okay, that's it for the show. Thanks to Jason. Thanks to Zed. Thanks to RCM for sponsoring. Thanks to Jeff Berger for producing. As mentioned at the top, that's a wrap for this season. Season 4, I believe. We'll be back in the new year for Season 5 and 25. Have a happy and safe holiday season. Until we talk again, peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.